Thank you for joining me. Today's weekly update. Let's get right into it. If you have questions for future videos, service@o'harewealth.com, or you can text us. Question on everybody's mind: what's the Fed going to do? Now, you're watching this on Thursday. I have the unfortunate ability to record this on a Wednesday, so I actually don't know what the Fed has officially done. But our estimation is that they're going to lower by a quarter point. That's the market's anticipation. If that doesn't happen, the market's probably going to be pretty upset about that, because the market really doesn't like surprises. Their anticipation right now is that the Fed will cut by 25 basis points. Why is this important? Remember, the Fed has a dual mandate. They are looking for full employment, and they're also looking for stable prices. Sometimes those two things are in competition, and that's what's been happening a lot recently. The Fed's been afraid to lower rates because they don't want inflation to get out of control. And why wouldn't they be afraid of that? Well, let's face it, when we got tariffs, people's inflation expectations rose considerably. People were expecting 5, 6% long term inflation. Even when we had 9% inflation on the CPI back in 2022, people's long term inflation expectations were nowhere near that high. Right? They were still 2.5%, 3%. So people's inflation expectations were very high. If those expectations are there, people start behaving as though inflation is coming. They can cause inflation because they expect inflation to be coming. So they start raising prices and raising costs because they're expecting inflation, and essentially inflation begets inflation. And once that cat's out of the bag, it's very hard to put that genie back in the bottle. So the Fed's been very nervous about continuing to cut rates because they don't want inflation to get out of control. What they've gotten more recently is softening job data. Although the economy is overall very healthy, the jobs data isn't as good, and they do have another mandate, is full employment. So they're going to lower rates a little bit here, but let's look at a chart of what rates have been really since 1993. We think we're in the middle of a soft landing. If that's the case, we're looking at sort of a period like 1993 to 1999. The Fed raised rates like we expected. They sort of stalled at the top, and then they mostly went sideways a little bit down, and then eventually back up again. Really sideways for the most part. The green line here, if we look closely, is what the market is betting and expecting the Fed to do. The blue line is what the Fed has announced they're planning to do, and the purple is their long run projection. The market thinks that the Fed's going to get there a little bit quicker than the market thinks the Fed's going to get there a little bit quicker than the Fed thinks they're going to. After years of doing this, funny story, the market's usually more right than the Fed. Fed is about their own announced plans. So if rates come down, what does that mean? And this is very important. It probably doesn't mean as much as people think. Yes, it's probably a nice reprieve for the federal government because they borrow at these rates and they borrow the majority of their money on a very short term basis. But for the average American and for the economy, it probably doesn't shift things nearly as quickly as people think. This isn't going to save housing because the market controls the 10-year Treasury rate, which is what mortgages are based off, not the Fed rate. Nobody's changing and making huge wholesale changes because the rates of their CDs went up or down. This is going to have a direct effect and a little bit of a wealth effect in the short run. I made this joke yesterday with somebody about interest rates, and they said, well, if rates go down, it's going to save people interest rate expense. That'll be good for them. The problem is most people, and when I say most people in the economy, that are the biggest spenders don't actually pay a lot of very short-term interest rate costs. And I would compel most people to say, what's the interest rate on your credit card? Most people don't know. And frankly, a lot of my clients don't pay interest on their credit cards because they pay their statement every month. So they're not really saving a lot in interest expense. They don't have a lot of borrowing outstanding. But what it will do is it'll lower the amount they get in their checking account, it'll lower the amount on CDs going forward, and actually decrease the amount of interest they receive. So that's a net negative short-term effect. So, how is this going to change things? It's probably good from a liquidity standpoint. It gets us to a more normalized curve. Eventually, we're going to have rates probably closer to about 3%, which has been our postulate for a while. And in that case, if you have 3%, you have, I'm not exactly sure what it'll be, but 3.5% on the 5-year, and then the 10-year Treasury right now is about 4%. Well, then you have 4% on the 10-year and a little higher after that. The rest of the curve is probably already lined up for the Fed to lower rates. So it probably doesn't make as big of a change. And those long-term changes with the 10-year Treasury rate, that affects cap rates, that affects investment rates, that affects how people want to borrow. Not overnight rates. So as this change happens, yes, it's probably a good sign the Fed's listening. And by the way, the Fed is listening. They're usually the last ones to the party. They're usually not proactive. They're reactive. That's what we should be expecting. But we don't think that this is going to make a wholesale change. We don't think it's going to let inflation out of the bottle. But we think that for the most part, this Fed rate cut is expected. It's going to offer a little bit of liquidity for the market to be able to go a little bit higher. But we're not going back to zero. If the Fed does cut rates back to close to 0 or 1%, there's something very wrong in the economy. We have a whole different set of issues at that point. So what are we expecting? We're expecting a few cuts over the next several months, and probably getting and marching close to that 3%, and then probably stopping again and going sideways for a while. So from the short end, what actually happens here, there's a lot of different effects, and a lot of them are kind of counteractive. It's probably not as big of a deal to cut by 25 basis points. I don't think anybody's making huge wholesale changes in their life based on a 25 basis point change to essentially checking account and CD rates. But with that, hopefully you tune in next week. Book recommendation for the period right now is Americana, 400-Year History of American Capitalism. Make sure to check it out here, and we'll see you next week. Thanks.